Alright, welcome back to another edition of Intermediate Accounting 1. We're going to move ahead into Learning Objective 3 of Chapter 11. We're going to skip Learning Objective 2. I do not anticipate testing you on that, so we'll start with Learning Objective 3. So what is Learning Objective 3 all about? Well, it has to deal with assets that have become impaired, or should we say, somehow have become, I don't know, broken, or they've just worn out. Impairment is somewhat of an unusual decline in use or productivity. Okay. However you want to classify, however you want to think about it, the idea behind impairment is that we have assets on our books that are potentially too high in value. So if we have paid $100,000 for a piece of equipment and its current net book value is roughly about $600,000, we have to test to make sure that we are going to collect at least $600,000 in value, or derive $600,000 in value from that asset. If the net book value is close to the end of its life, and let's say it's got a carrying value or net book value of $50,000, do we expect to derive that value by continuing to use it, or should we go ahead and sell it and try to get $50,000 in cash? The idea behind here is that net book value, we have to look at net book value in a kind of a different way. Either if we have, say, $50,000 of net book value, are we going to derive $50,000 in productivity value, or are we going to cash out, let's just say, $50,000 in, say, salvage value? That's the idea behind when we look at net book value. That's how we want to kind of criticize our own fixed assets. If we think that we will derive or cash out something less than this, then potentially the asset is impaired and we need to write it down or bring it down to whatever its fair value is. So that's the idea behind Learning Objective 3, is that we're critically looking at our machinery, our buildings, our airplanes, our vehicles, and we're trying to looking at the net book value and asking ourselves, can we still derive that value? That whatever the net book value is, are we going to get that value somehow? So potentially, we have to either write off or write down some portion of our long-lived assets. Sometimes the events happen, we're not even aware of them. Sometimes the events happen and it prods us to actually do an impairment test. So for instance, if we figure out that there's a significant decrease in the fair value of an asset, a classic case here is like computer equipment. Maybe we have old servers and there's a new processor that's come out that has made all of our servers relatively obsolete. How can we get rid of these things? We may have to just kind of donate them potentially. So there's a significant decrease in the fair value of the asset due to maybe a technological innovation. There's a significant change in the manner in which an asset is used. Maybe we change our product lines and we no longer need a specialized piece of equipment. In that case, if we don't keep using it, if we stop using it, it's just going to sit there and collect dust. What are we going to do with that? If the asset has no use for us, we got to write it down. A significant adverse change in legal factors or in business climate that affects the value of an asset. So if say for instance, our factories, yes, they pump out a little bit of pollution in the air, but new EPA or Environmental Protection Agency regulations come in and they say, no, you can no longer pump that much carbon dioxide up in the atmosphere. Maybe that requires us to write down some of our equipment that produces that CO2. An accumulation of costs in excess of the amount originally expected to acquire a constructed asset. Yeah, it's possible that can occur, but it rarely happens. Usually our estimates of what we expect to pay to acquire an asset are pretty spot on. Are there cost overruns? Yes, but usually they are within a reasonable expectation amount. So don't worry so much about that one. A projection or forecast that demonstrates continuing losses associated with an asset. Yeah, we can continue to drive our use our vehicles, our buses, our vans to drive around in packages, but the cost of operating those vehicles outweighs the value derived, the revenue derived from delivering the packages. So maybe we need to either scrap the delivery route or maybe we need to buy a new piece of equipment. Either way, the current van that we use needs to be written down. It's not working for us anymore. So how do we measure the impairments? If there is an event, okay, now what do we have to do? Well, we review the events for possible impairment. You don't have to worry about that. I just tell you something has been possibly impaired. If the review indicates impairment, apply a recoverability test, which is if the sum of expected future net cash flows, the inflows, let's say, the net cash inflows from the long-lived asset is less than the current carrying amount, i.e. net book value of the asset, then an impairment has occurred. In other words, if we have a vehicle, let's say we have a delivery van, and the net book value on that sucker is $50,000. Okay, we're going to continue to operate this thing for the next year, and then we're going to get rid of it. Can we anticipate that we'll generate at least 50K or more in, say, revenue? If we don't expect that, let's say, for instance, we only anticipate 35K in revenue, then potentially we have to write down this asset. In other words, this thing that we're going to use for the next year and then get rid of, it's not even going to generate enough money to make up for its own carrying value, its own net book value. Assuming that an impairment has occurred, the impairment loss is the amount by which the net book value of the assets exceeds the fair value of the assets. So if I have a net book value of, say, $50,000 of this piece of equipment, and I go on Kelley Blue Book and I do an estimate, and let's say the thing is currently valued at roughly $20,000 fair value. Well, guess what? I have to take a loss of $30,000. This is the idea behind critically evaluating our assets. We have computer equipment, we have chairs, we have desks, we have buildings, we have airplanes. We had to, at least as long as an annual basis, if not quarterly basis, look at each piece of long-term asset and ask ourselves, is the value that we're going to get from that airplane, building, whatever, equal to or greater than its current net book value? If not, we got to write the thing down. The only question is by how much. So here's a little flow chart where they kind of walk you through the tests. I think we should just look at an example. It'll be a little bit easier for us. So on the next page, we have MLU Inc. that has equipment of $600,000, has a net book value, carrying value. Just think about this as net book value of $600,000, 800 cost minus 200 accumulated depreciation. The company determines expected future net cash flows undiscounted from the use of the equipment is approximately $650,000. Okay, so you can probably determine here that just from looking at here's our carrying value, $600,000, and here's the future cash flows. Well, future cash flows are greater than the current carrying value, so I probably don't have an impairment. True enough, so let's just write that sucker in there. I'm going to skip down to, what is this, the third line here, and write $650,000. That's the expected future cash flows of this piece of equipment. What's the net book value / carrying value? Well, it's $800,000 minus the $200,000 accumulated depreciation, $600,000. Then we have to ask ourselves, which one is bigger? Well, this one is bigger. So, no impairment. Yay. That's good news. We don't have to write down the asset. It's still going to provide us value, and that's what we would hope for. If we paid 800,000 for this thing, and it's currently going to provide us 600,000 more in value, we would hope that it's at least going to help derive that much value for us. Now, one thing I want to make sure it's clear, I only want to worry about assets that are held for use. There's also a bit in the book where they talk about there are different rules for assets held for planned to be disposed of. You only have to worry about assets held for use in this example. I think it's a little bit simpler to understand. In the situation here, we have the same amount, same net book value, 600,000. That's down below. But this time we have 580,000 in future cash flows. Make sure you don't mix up the name. Future cash flows first, fair value second. Future cash flows. Now in this case, what do we have? We have our net book value is bigger. So that means, yes, we have an impairment. That's womp womp. Oh. Okay. So first compare, so that again, compare future cash flows versus net book value. If net book value is bigger, then we got womp womp. Going to write the sucker down. How do we do that? Well, we have to then now look at the fair value, or what I prefer to call it fair market value. FV tends to get a little confusing sometimes. So we know that we have an impairment. How much? This is step 2. Step 2. How much? All right, step 2. We've got a fair value. Let's put the sucker all the way down here of 525,000. And what we need to do is make the net book value equal fair value. So I need the net book value or the carrying value to be 525,000. So what do I need? By how much do I need to write down this asset? $75,000. That's it. Write it down. Now the net book value equals the fair value. We can write in the journal entry as such. Debit, loss on impairment. On the income statement for 75,000. Then credit accumulated depreciation. Now, here's the thing that causes some people some headache here. Yes, there is a loss. It should be reported on the income statement. Not depreciation expense, because the thing didn't really depreciate from wear and tear, from use. We just simply lost value. When you think about expenses and losses, losses are reductions in value that are out of our control. Expenses are reductions in value that we take some sort of deliberate action to help manifest. So expenses are more deliberate, losses are incidental. So this is a loss, this is incidental. We just found out that there's less value in this piece of equipment. So fair enough. We write it down, record a loss. That hits our income statement somewhere in the middle of the income statement in the other stuff. Why do we credit accumulated depreciation? Why don't we credit the overall cost basis? Well, this does the trick just as well. If we increase, this is an increase to accumulated depreciation. Okay? If we increase accumulated depreciation, the overall net book value goes down. So decrease in overall net book value. So that does the trick for us. But also kind of keep in mind this, okay? We didn't really recognize depreciation, but there is somewhat of an accelerated reduction in value. Maybe the way we depreciated the asset was too slow. Maybe we should have used an accelerated method of depreciation. Take, for instance, the double declining balance method. Maybe we should have been using that all along, because if we had used the double declining balance method, we probably would have had much more accumulated depreciation and much less in net book value, in which case we wouldn't have to necessarily have a write down. So it is kind of a function of our depreciation methodology choice, even though it's theoretical. So in this case, the best option is to simply say the depreciation is separate from a loss. Depreciation was from deliberate use. The loss was outside of our control. It was incidental. But it all gets funneled into accumulated depreciation because it's the contra asset account that brings down the overall carrying value of the asset to its, in this case, fair value. And that's all I have to talk about for learning objective 3.